Hello and welcome back. This is David from the Personal Finance Squad. We just finished up with section 3.2 where Jasper decided to bowl in a league. What we saw here was the value of using a supplemental account where he established a monthly amount to pay into it even though he might not be bowling for the entire year. The value of it was to see the inflows into supplemental and the cash flows back into the account for the months where he needed money to draw from it. So what we want to do here in section 3.3, which is upfront cash for monthly fluctuating payments, is twofold. One is to establish the understanding of using the supplemental account for the 12-month cycle, but the difference here is that on any given month, the amount of money you pay may be different. So for example, you may have a service every month you pay for, but you just don't know the number of days all of the time. The other part is to establish upfront cash. This cash would go into the supplemental account based off the 12-month cycle prediction. So what we're saying here is there might not be enough money at certain points during a year to cover an expense. What we mean here, you might run into a negative balance at some point. The 12-month cycle exercise will show us that, and what we need to do is account for that to make sure there's enough money there in the beginning to handle it throughout the year. So what we have in front of us here is a common, just a calendar, right? So when we say upfront cash for monthly fluctuating payments, we just kind of went through this. Some other examples are, say, tanning and yoga classes. Oftentimes you may just pay for yoga as you go, or you pay for a pack and you use them as you use them. So you might have 20 yoga classes, and in 1 month you might use all of them, and the next 3 months you might use the next 20. So this is what we're getting at again with a varying schedule, but a schedule where, again, you're using a service or paying for something on a monthly basis. So I'm going to scroll down here a little bit, and we can see that the calendar has some red numbers on it. And those days are highlighted that are considered holidays. So what we're going to perform in this exercise is for daycare. So these are arbitrary dates, of course, that are in red, but this is, again, a sample schedule. This is a schedule, if you will, that Jasper has. So we can see here, again, like we did with bowling, we need to know the parameters. We need the understanding of not just what it costs to go to do something, but also anything that's ancillary on top of it. So we can see here that Jasper's general schedule for his child is Monday and Wednesday, and that every time he goes, he pays $37, and every year there's an $85 registration fee. Again, you can see holidays and vacations are highlighted in red. So this is a really nice representation of talking about planning out for a year. So scrolling down here a little bit further, the math has already been done so that the Monday and Wednesdays are accounted for. And again, you can see here that we have a little grid that lists all of those out. And just like we've talked about with bowling, some months bowling was 110, and other months was 88. And that's because there's an average amount what's paid each month, but in the same token, you don't go all the time at the same frequency. So this is why you see disparaging numbers rather than saying in January, in February, and March, you go 7 times. So again, how the calendar lays out will also dictate how much money needs to be paid. So you can see the pattern here. It's pretty consistent. There's the variance, the standard deviation is about 2 in most cases, and October has an exception that has 10. You have a few 9s, but generally you're going to be, you know that you're going to be between 7 and 10. So you can see here of adding up this grid that the total number of days that need to be used for daycare comes out to 95. So doing the same type of exercise we did with bowling, we say $95 times 37 each day comes out to $3,515. And we divide that by 12 and we come out with a monthly average of $292.91. Now we can also see that we want to add this $85 here because that's a yearly registration fee. So that comes out to $7 and almost 10 cents, $7.08 if you will. So we take that number, add it to the $292.91, and that comes out to just under $300. So that is the number we're going to work with. So if we go to 300, now do the full math. Actually, this should be multiplied. We'll have to fix that. 300 times 12 equals 3,600. Now the next thing we want to get into, which we talked about just a little bit ago, was that we need to understand if we're going to need upfront cash to help pay for bills later so that the supplemental account does not run into the negative. If the first 3 months in a cycle are projecting over the budget, money will be need to be paid by some other source, right? And again, we always say, well, you could go to savings, you could go to miscellaneous, what have you, but that's not the way we budget. We might have to get some money to establish this, but we want to have this so you're always covered. You never want to say, I do not have enough money, because if you don't predict that right, you are going to pull out of savings, or your monthly savings, like Jasper's 703 number, will be impacted if you miss, and we do not want to miss. So what we have to think about here for yourself is that budgets are all individual. So what we're talking about here is when you're establishing your own budget, or you're a student in the class, or you're somebody reestablishing your own, you need to think about what's important to you first, which is necessities. So in Jasper's case, childcare is a necessity. Now, so is rent, maybe gas, and now just say, for example, in Jasper's case, he just didn't have the means to do it. He might cross out something like a bowling league and go, you know what? Maybe I can do this at another time. Okay, so we want to go down further and see how this all plays out. This is a little bit deeper than we went into bowling. This allows us to see here in this year's grid to understand and identify if there are gaps where money is going to be needed. So you can see here that in the first month, there's money sent to the supplemental account, because the prediction is that it's going to be 266 and change, 266.08. We don't see the number here, but that's about what that is. So in this case, after the first month, you have 33.92, which is great. But then we see a difference. This month, February, it's going to be 340.08. And then we're going to have this right here in March at 308. But you can see right here in February already, you're going to run to a balance of negative $6.16. And then in March, again, 308. So it's $3.08 over the predicted amount of 300. We go deeper. And then again, we see another 40.08 over, and you can see the pattern here. So we have 5 months in a row where all of a sudden the amount goes to $55.48. So what we've done is a little math here in July, and we say we know we're $3.08 over again, and we know what the balance is going to be. So based on this last month here, what's left over, and that what the math is here, it's going to calculate that the balance at that moment is going to be $58.56 in the hole. So what we do here is we understand at this point we want to get it to zero, right? This is the point we say zero because in the next months, August and September, we're putting money back in again. So you can see here in green, we call this added cash, $58.56. Now by doing that, we get to zero. And then we add 33.92 twice, we get to 67.84 at the end of September. And then October, we're drawing money back again, and you look and see, you know what? Oops, we're going to be $9.24 in the hole. And then we're going to be another $12.32 in the hole. And then December's a light month, so we find out that $70.92 is what is going to be needed. So going back just a second here, this is another point where it was decided that we are going to balance it out. So that 1232 is covered right here, gets us to zero. And then when the last month of December, we see that $70.92, the budget is under. So you actually end the year at 70.88. You got to understand here, it might look a few cents off here. I want to point out that, and it's actually written in the text as well, that the numbers are not exact numbers, so meaning they're not fully rounded, that you might get a minor discrepancy in the numbers here, but you can see it's awfully close. So again, you can see when the money was in, the added cash was added in, that it did it at a time where the next months were going to have positive amounts. But truthfully, you can run this whole exercise down and the numbers will come out for themselves. You could have stayed in the negative here and not paid the 58.56 and went back and forth and did the whole exercise. The whole point is you would have ended up with the $70.88 number. This is just a way to see when you would really run out if you ran this scenario. But what we're going to do is never run into this scenario. This is just to identify how much money we're going to need for upfront cash. And so also understand we don't always need upfront cash. Like with bowling, we did not. But daycare, we do. So everything I was just talking about in that grid is what all this dialogue is here. So what we'd like to say is that we talk about the added cash. And now we know that this 70.88 is going to be added. And this is the beauty. This is what makes your bill a flexible amount. This makes this 300 here happen every month. And we always look for a fixed bill amount for the entire budget. So this is a great example of why this exercise is important and why it works. So now you can see here in this grid, this is the prediction grid now of what would actually happen if we reran the exercise. We can see here that now we start the first month at 300, and just like before, 33.92 would go to supplemental, but now the added cash is in there. And now there's a supplemental balance of 104.80. And now as we run the cycle, we're going to have the next 6 months from February to July where money's going to be taken out, and the balance trickles down again back to that. If you recall, there was a point there was $12.32 that we were in the hole, but now we're not in the hole. We're actually a positive. Then we had these 2 months where cash was added. Balance goes up to 46.93, 80.16. October, November, they take money out because the bill was under. And now we're at 0 in November. And then we find out in December, like we said before, this was a light month in terms of daycare, probably because of holidays and time off. $70.92 is what the trailing ending balance is. So what we do with this balance is we take it, and for the next year's cycle, you stick it back in added cash. And then it keeps replenishing itself every year so that you're covered. So therefore, this $300 amount every month will maintain. Again, down here's a notation if you're reading here. This is what I talked about, rounding numbers. But you can see here there's a 4-cent difference between to sup and from sup and added cash and supplemental balance. So when you play it all out, the numbers do balance. Okay, one last thing I want to point out here. Remember to go back and read. This is a lot to digest. And if you take your time, it will make sense. And certainly there'll be other tools as we go through this to see how this operationally keeps happening and will work. The other piece though with that is every year we do a 12-month cycle, correct? So this means you're going to have to go back, shoot back up here to your calendar for whatever year that you would apply to do this, and start the exercise over. You got to go back and then do your grid again. Say, okay, I know the number of days, and start the whole exercise over again. Now, once again you get this going, you're pretty much going to know within a number of days of what you have to add into your supplemental. It becomes pretty easy. That's why when you perform these exercises, again, it becomes, you know this, you get used to it. It'll become a lot more clear as you exercise it. But that's why it's important to make sure that, for example, if daycare went up by $2 a visit, and I believe there was 95 visits. So that's $190 you'd have to add in there, and you'd have to make sure that that's accounted for. That would make the average go up. See, if it was $3,600, you added 190, now you have $3,790. Divide that by 12. That would come out to $315.83. So you can see, hence, this $15.83. That is the difference you'd have to add to your budget instead of $300. Now, in some cases, it could go down. Eventually, you may not need daycare, so that would be a bonus, because more than likely that money is going to be redistributed back in your budget. So again, take your time, perform the exercises, understand what it is, understand the ancillaries, get the entire cost, get the average, map out what it's going to take to go do it by month, and account for that upfront money. And you can see in most cases it's probably not going to be a lot of money. This will happen throughout your exercises as we go further. It will not be a whole lot of money you're really going to need to put up front. So that's the good thing. Okay, so that is going to conclude this exercise. I appreciate you sticking with it, and this is going to really be a nice benefit to your budget as we continue forward. Thank you, and we will see you in the next video.